Welcome back. This is the second video in a series that explains a discovery that the Journal of Accountancy called the missing piece in liquidity calculations. The missing piece is the current portion of fixed assets, CPFA. There are two ways that the missing piece will benefit you as a financial analyst, further detailed in two articles in America's leading banking journal, the RMA Journal. The first, which I covered in my first video, illustrates that when the current portion of fixed assets is included in the calculation of working capital, negative working capital becomes positive. The second and even more exciting discovery is that there are two tiers of liquidity, trading capital and working capital. We will cover this topic in our next video of the same name, trading capital versus working capital. But first, in this video, I want to answer the questions and the challenges that have been raised since CPFA was first announced back in 2012. Incidentally, all of these articles are available free on my website, SME-Lending. Now, most questions and challenges revolve around one key question. Should the current portion of fixed assets be counted as a current asset? That has serious ramifications for how we think about and calculate working capital and liquidity. To begin, I want to emphasize that no one in that first decade of discussion has challenged the concept of CPFA. That's because the concept is grounded in generally accepted accounting principles. Generally accepted accounting principles, GAAP for short, requires that the portion of fixed assets used in the preceding period must be reported as depreciation expense on the income statement. Depreciation expense looks backwards in time. CPFA looks forward in time. CPFA is defined and calculated as the portion of fixed assets that is scheduled to be depreciated in the next period, the current period. So depreciation expense and the current portion of fixed assets measure the same thing, depreciation, but for different periods of time. Just imagine, you are a CEO of a company, and you're thinking about how much you should invest in fixed assets this year just to replace that which will be depreciated, just to stay even. Call it maintenance CapEx. So you ask your CFO, how much depreciation expense do we have scheduled for this year? That's it. Give it a name. The current portion of fixed assets just gives a name to a number, a very useful number, that is at the fingertips of every CFO. In all our training and all our experience, there are current assets and fixed assets, mutually exclusive, divided without ambiguity. GAAP agrees. The concept of the nature of current assets contemplates the exclusion of such resources as the following. Item F is depreciable assets. In plain English, fixed assets are not current assets. And that, of course, was the reasonable ruling to the question that the Financial Accounting Standards Board, FASB, faced at the time. Are fixed assets current or long-term? But that was before the discovery of CPFA. The new question for FASB to consider is this. Is the current portion of fixed assets a current asset? In fact, the current portion of fixed assets is entirely consistent with GAAP's definition of current assets. Current assets is used to designate cash and other assets or resources commonly identified as those that are reasonably expected to be realized in cash or sold or consumed during the normal operating cycle of the business. What does it mean to be realized in cash or consumed? Well, in the normal operating cycle of a business, a company uses all of its assets to generate revenue. As the assets are used up, consumed, they are effectively converted back to cash, realized in cash. When fixed assets are used in the normal operating cycle of the business, they are also consumed and effectively realized in cash, but over multiple years. each year only a portion of the fixed assets is consumed and realized in cash, the portion of fixed assets that will be consumed and realized in cash in the current period is a current account. GAAP has already established the precedent for slicing the current portion off of a long-term account. GAAP requires that the portion of long-term debt due in the current period be sliced off and reported as a current liability. With the discovery of CPFA, we can now apply the same logic to the left side of the balance sheet, slicing off the portion of fixed assets that is scheduled to be consumed, depreciated, in the current year, and reported as a current asset. What applies to the right side of the balance sheet must apply to the left. Consistency is an important objective in GAAP. And look, current now includes everything that is expected to be written off the balance sheet in the current period. That includes all of the usual current accounts that turn over in their entirety, inventory, accounts receivable, accounts payable, and it includes the current portion of the long-term accounts, the portion of long-term debt that must be paid in the current period, and the portion of fixed assets that will be depreciated, written off in the current period. All that remains in the non-current accounts is the portion of long-term accounts that will remain on the balance sheet at the end of the period, to be used or paid in future years. This gives us a simple, logical definition for current accounts. Current accounts include everything that is expected to be written off the balance sheet in the current period, and that includes CPFA. The accounting logic is compelling, but this is what really bothers us. We say that inventory is liquid because it can be exchanged for cash. The cash may be delayed as an account receivable, but it is still realized in the current period, so accounts receivable and inventory are both considered liquid assets. In contrast, a truck is not perceived to be liquid because the company does not exchange the truck for cash. Let's think about that. Remember Sam from the first video? Sam invested in a truck to start his business, moving, hauling, delivery. When Sam agrees to haul something for a customer, he is agreeing, in essence, to exchange a portion of the value of his truck, the wear and tear, the depreciation that reduces its value, for cash. Now let's think about Sam's friend Susan, who buys and sells product. Her primary asset is inventory, which she financed in part with short-term credit, possibly from her suppliers or her bank. Her current assets exceed her current liabilities, so she's considered to be liquid. But Susan cannot take a box of inventory to the bank, drop it on the desk of her banker to pay her loan. Assets do not repay loans. Every company must use its assets to generate revenue to repay its loans. Susan must sell her inventory to get the cash to repay her creditors, and Sam must use his truck, a fixed asset, to generate revenue, cash, to make his loan payment. This is a common challenge. This entrepreneur correctly points out that revenue from the truck is dependent on the truck being used. A university professor agreed. There is no guarantee that the truck will generate cash. Absolutely true. Sam must use the truck to generate revenue. But that is equally true for Susan. Susan must sell her inventory to generate revenue, and there is no guarantee that she will. Sam is just as likely to find a customer to pay him to haul something as Susan is to find a customer to buy her products. Here's the point. Either entrepreneur can generate cash from revenue in the current period, regardless of the fact that one is using a fixed asset while the other is using a trading asset. And to be absolutely clear, I'll add this corollary. Revenue does not have to go through current accounts. Sam has no current assets, no inventory, no accounts receivable, nor does he need them. The revenue, the cash, comes directly from the use of his truck, a fixed asset. For this final challenge, I will quote a partner of a major accounting firm, who I believe is drawing on the GAAP concept statement footnoted below. The partner wrote, "The subjective calculation of depreciation, method, useful life, salvage value, is not as reliable as the objective contractual payments due in the next year on debt. So FASB would not prefer my approach." Notice the partner is not challenging the concept of CPFA. He accepts that CPFA is the measure of next year's depreciation. In fact, he refers to it here simply as depreciation. His challenge is that CPFA depreciation is too subjective. It is true, we do not know exactly how much a fixed asset depreciates each year. It is a subjective estimate based on the judgments about method, useful life, and salvage value. It is also true that depreciation is not as objective as the contractually required payments due in the next year on debt. Nevertheless, depreciation is an essential GAAP concept. The fact that the quantity is difficult to pin down does not mean the quantity does not exist or can be ignored. To the contrary, GAAP requires the reporting of depreciation expense and provides the guidance for setting up depreciation schedules, which dictate the depreciation for each year of the life of a fixed asset, last year's and next year's. So CPFA is exactly as precise or imprecise as depreciation expense. If we do not report CPFA because it is too subjective, then we should stop reporting depreciation expense on the income statement because it is equally subjective. You know, inventory is also subjective. GAAP allows for a number of methods to value inventory, FIFO, LIFO, average cost, all based on subjective judgment. We do not exclude inventory from current assets just because it is subjective. Nor shall we exclude CPFA from current assets just because the calculation of depreciation is subjective. In short, the problem with how we think about liquidity today is that we require the payment of long-term debt due in the current period must be covered by the current assets as reported on today's balance sheet, which fails to recognize that fixed assets also contribute directly to current cash flow. Once again, Sam does not need inventory or receivables to make the payment on his long-term loan. Sam will use his truck, a fixed asset, to generate the revenue to repay his loan. Working capital as we calculate it today is routinely understated. And for companies that are heavily invested in fixed assets financed by long-term debt, like AT&T, Walmart, and Sam's truck, it may even appear negative. If CPLTD is included in the calculation, CPFA must also be included. They were placed on the balance sheet at the same time when the long-term loan was granted to acquire the fixed asset, and they will be reduced together year by year as the fixed asset generates revenue to repay the loan. So the answer to today's question is yes. The current portion of fixed assets must also be counted as a current asset. And that brings us to an even more exciting discovery. In the next video, we will take the current portion of long-term accounts, CPFA and CPLTD, out of the calculation, which produces a new concept of liquidity, a second tier of liquidity, trading capital. And we will see that analyzing trading capital and working capital together provides greater insight into liquidity than was ever possible before. The next two videos will be based on this article from the RMA Journal, Trading Capital versus Working Capital. This and all of my articles are available on my website, sme-lending.com, as well as the book, which covers everything in the articles and much more. Thank you for watching this video. I hope you liked it.